What is a mortgage? A mortgage, also known as a mortgage loan, is used by people to raise money to buy a property. In other words, it is money that we borrow to purchase a property. Most of us need to take out a mortgage when we purchase our first home. Existing property owners may take out a mortgage to raise funds for any purpose. They put a lien on the property being mortgaged. A lien is a right to keep possession of another person's property until they pay off a loan. If the mortgagor cannot keep up with the loan repayments, the lender can take possession and sell the secured property to pay off the loan. A full mortgage, or 100% mortgage, is a loan that equals the total price of the property being bought. Whether borrowers get a full mortgage depends on their credit score, how secure their job is, and the state of the financial market. Since the global financial crisis of 2007 and 2008, most banks ask for a down payment. In other words, borrowers must put up some of their own money. The loan-to-value ratio, or LTV ratio, is used by lenders to assess the risk of people applying for a mortgage. For example, if the house you want to buy is worth $200,000 and you want to borrow $100,000, the LTV ratio is 50%. As far as the lender is concerned, the greater the LTV ratio, the higher the risk. People with good credit scores can get a greater LTV ratio than those with poor credit scores. Dry mortgages versus wet mortgages. A wet mortgage is one in which the funds are released before all the paperwork has been completed. Wet mortgages are useful if you are in a seller's market and need to act swiftly. A dry mortgage is the opposite. The funds are only released after all the paperwork has been completed, checked, and signed by all parties concerned. Thank you for watching this brief market business news video on mortgages.